Hi, hello everyone. So let's start discussion on a very important topic, guys, which is infrastructure project finance, structure and bankability terms. We are going to look and where we are going to discuss the what is the key difference between the infrastructure project and the corporate borrowing. What are the borrowers, recourse, credit base, risks, and security we are going to discuss. And then we discuss on the five phases of life cycle of the infrastructure project. What are the stages that are faced by the infrastructure that we look where the development, origination, structuring and financing, construction, operation and transfer, and the decommission is that stages we look each and their key concepts, what they involve in the infrastructure finance and how it will do by the analyst. Then we are going to discuss on the very important part for the special purpose vehicle. What are the ring facing for the project? Why they created the special purpose vehicle? It is and the separate entity. So we will discuss all these things in detail. Then we are going to discuss on the capital stock layer and the risks and return. So what are the capital stock? What are the reals? Reals and the risks and the returns. Then we are going to discuss on the cash flow waterfall, the run book, what are the the order payment for the project revenue, how they make, what are the things that included. Then we discuss on the how the work together bankability will work. Then we discuss on the two examples. I'll specifically created these two example, guys. It is and the best example for the infrastructure project where we are going to initially discuss on the 100 megawatt power plant, and then we are going to discuss on the four land road for the power private uh, public private partnership agreement. What are the documents you going to review, then discuss on the annual cash flows, then the key takeaway from this video. So guys, let's start discussion on the second slide where we are going to discuss on the infrastructure project versus the corporate borrowing. So what are the key things that will differentiate between the infrastructure project finance and the corporate borrowing? We discuss on each aspect. So where we are going to concept cover the aspect like borrower, recourse, credit basis, tenure, risk allocation, and the security. So in the borrower perspective, so infrastructure project finance, there is a specially created one of the separate entity which we call a special purpose vehicle. For that, the infra that works only for that specifically infrastructure project. So that entity is a separate entity. It is and the legal entity that created by the sponsor for to that specific project. So where in that special purpose vehicle some amount of debt, some amount of equity that's supported by the sponsor. So it's debt to equity ratio in the infrastructure projects is a 70 to 30 is a good and acceptable. So then corporate borrowing, operating the company. So the operating company, the company anything is operate and it's required the the borrowers that required for their company progression. So that's why they can go and borrow the corporate borrowing for that company, and that will be impacted on their balance sheet. It is the recourse financing. So it's that the thing comes under the corporate borrowing. If the in the case of the special purpose vehicle, so there is no the lender will liable to touch their balance sheet and use the personal assets of the sponsor. But in the corporate operating companies or the corporate borrowing, they can touch their the personal asset or they can touch their balance sheet to recover their the debt service principal and the interest rate. Then they discuss on the second aspects, which is a recourse. So non-recourse and limited recourse. So the infrastructure project finance under the special purpose vehicle, which is a non-recourse and that have the limited resources. We are not going to touch the balance sheet of the sponsor. We just depend on, or we created the escrow account or the debt service account. We write down the covenants and accordingly we take the principal and interest or cover. If they don't have the that much resources under that special purpose vehicle, so it is high risk and we lose the amount. But in the corporate lending, the full recourse to the company, they can recover from the company, sells the company asset and recover. So credit basis, project cash flow and the contract is of most important, and the credit basis. So as an analyst in the infrastructure project, guys, you should understand, you should read all the contracts in detail, how they work, understand the project cash flow, how the cash flow will inflow and outflow, what are the debt service coverage ratio, loan life coverage ratio. You should understand how the project life coverage ratio will work and how much they are breached. You should do the stress testing, sensitivity analysis, scenario analysis, gap testing to consider the different kinds of scenarios. In this case, what are the debt service, what are the, if suppose the maintenance delay for the 2 years, operation and maintenance cost increasing for 10%, or the cost of raw material or the required raw material will increases, if there is any fraudulent activity done by the sponsor on that or the sponsor working members, so that we need to identify. Then the corporate balance sheet and EBA are the earning before interest tax is the credit basis for the lender in the case of the corporate borrowing. So let's discuss on the tenure. Tenure is a, one of the most important concepts, guys, and that will be differentiate between the infrastructure project finance and the corporate borrowing. So tenure in the infrastructure finance is a 10 to 30 year. It is a long gestation, long tenure financing. It's the 30 years financing for one of the projects. So shortest is 1 to 7 years. It can immediately recover from that. So it's the corporate financing is a shortest, max to max 7 years it will be. So risk allocation. So contractually allocated to the best party. So risk allocation is contractually allocated to the best party. We have the different parties or we have the different borrowers, and we do their the credit appraisal note. We do their the analysis. Analyst will do a 360-degree analysis and identify best party that will be able to pay the principal and interest rate, and we take a back from the government, like a power purchase agreement or the public private partnership agreement, to read the concessionaire agreement, so that will help us. And then the corporate borrowing, all risks with the borrower, so the risks that will be with the borrowers. So the borrower will default, then he need to pay, but it is a contractually allocated, and the best part we need to identify in the case of the infrastructure project financing. So let's discuss on the last the security perspective. So project asset, contract and account that are involved in that, the special purpose vehicle, so that need to be the part of the infrastructure project finance, but is a different way in the security perspective of the corporate borrowing. So corporate guarantee debentures that are the part of the corporate borrowing. So where we are going to take a key points that lend to the asset, not a company. So what are the difference between in the infrastructure finance, we are going to lend the money for the asset. So we need to do what are the valuation of that asset in the future. We need to calculate the depreciation, appreciation of that assets, how much the revenue will generated by that asset. So that asset is the most important in the infrastructure financing and not the company. So let's discuss on the very important topic, guys, the 5 phases of the project life cycle, guys, in the next slide. So where we are going to discuss on the development, origination, structure financing, concentration, operation, transfer and decommissioning. So let's start discussion on one by one, guys. So first one is the feasibility, permit, land, key contract, power purchase agreement, uh, concessions, the public-private partnership agreement. On the basis of that project, what kind of that project? Road construction, rail construction, metro construction, power construction, water management resource, the solar energy, wind energy project, that is infrastructure project. So we need to identify that thing and develop the origination. And risks, high sunk cost, no certainty of clauses, reading the assumption, understanding the assumptions. So that's the important. Then the structuring and the financing. So set the special purpose vehicle, due diligence, negotiation term, and financial clauses, how that will be work. So set up the special purpose vehicle, the SPV, due diligence, negotiation terms. Then we are going to move on the next slide, where we are next the third stage of the life cycle, which is construction, where we are going to discuss on the EPC build assets, downtime timeline, downtime tight milestone, risks, delay, cost overrun, and the mitigated of LDs. So we are going to continuously check progress of the construction, what are the milestone they are achieving. What are the types of EPC contract, option and maintenance contract? It is a fixed price, fixed timeline, or different. So we need to check that thing and understand how much the construction is ongoing. We need to do the lender independent engineer report. We need to send the engineer to review their report, understand the progress of the projects, to do the audit on that project, understand the audit progress, why the delay, if some delay is there, so what are the amounts they store in the debt service coverage, debt reserve account, what are the escrow mechanism they follow. So we need to check that all these things, then transfer and de commissioning. So let's the PPA, public private partnership, the hand back to government. So in the last stage, once that the project is completed, the 25 years completed and the sponsor contract will expire, so then the public private partnership will give that hand back to the government, private sale the refinance and reduce the value risks with the equity. So the and that time government will be the owner of that project. So let's discuss on the next slide, where we are going to discuss the most important topic is a special purpose vehicle ring facing for the project. So let's we first discuss on the special purpose vehicle, and then we are going to discuss on the ring facing for the project. So the special purpose of vehicle is a standalone entity, which it is and the separate entity that is created for that projects, that own only the projects, that is only for the project. That purpose of the special purpose vehicle, if suppose the government of India launch the 10,000 crore highway project, so it's a huge amount of project. So there is a different the sponsor the comes and they bid and acts will happen, and one of the sponsor like Adani, Reliance will get that contract, and they in that time, they once they get the contract, they create the special purpose vehicle for that 10,000 crore project, and entire transactions and all these things will happen in that the balance sheet of that special purpose vehicle, not the balance sheet of Adani groups. Okay, so the standalone entity. So why it's matter? The ring facing assets and the cash flow from the sponsor. So it is on the ring facing asset and the cash flow from the sponsor. So let's discuss some on the ring facing assets. So ring facing is a financial or legal separation of specific asset, fund, operation unit from the company main businesses. It's the things, and ensure they are used slowly for design purpose and protect from the overall risks. It acts as a protect a barrier to maintain a safety and asset, often use a prevent the funds from being utilized and unrelated expenses, or secure the assets in case of bankruptcy. Those key aspects we should know: the asset protection, budgeting, grant, banking regulation, taxation, or the estate planning. So that's the key things we need to understand in the ring phase. So let's discuss on allow the lender to take the security over 100 plus projects, and so the lender, the sponsor can give that things. Then the central hub for all the countries like EPC, FPC, operation and maintenance, off-taker insurance. So that's the central thing for that thing. So off-taker, EPC contractor. So that's thing will happen there, and the insurance. So let's move on the next slide, guys, where we are going to discuss on the capital stack and the layers of risks and the returns that receive. So what are the capital stacks? What are the layers? What are the typical risks and what are the risks return and the priority of that thing? So let's discuss on the first one is the senior debt. So where typically the 60 to 80% it is the debt, and the risks and return is the lowest for 5 to 8% on the internal rate of return. So first paid from the cash flow. So that internal debt is the firstly paid from the cash. Then the we'll discuss on the mezzanine debt, which is the most important concept, guys. The mezzanine debt service provide hybrid financing. It is an hybrid financing, guys, where combining the debt and equity tolerated by mid-sized companies and the growth, acquisition and leverage the buyouts. So it's help and the leverage the buyouts. It brings the gap between the senior bank debt and the equity, offering the flexibility repayment, optic interest and principal. So with return of the 12 to 30 percent of lender, the key provider including the private equity firms and all the specialized mezzanine funds. So mezzanine fund is one of the things where we if you want, if you can act as a debt, and if you want, if you can act as a equity provider. So it's as the 10 to 15% typical, and it will medium give you the return, so 8 to 12%. And the securities second limited priority that have the second priority, and the equity, so it is the equity is a loss. So if the fund seeds come, then first that will distribute it to the senior debt, then the major debt, and then the equity holders. So in equity is a 15 to 30%, and the risk and return risk is a very high, guys, and the return is a 12 to 20% in the IRR. And last, the first loss position, the first loss, it is a given the loss of the profitability, but first loss position, they will firstly bear the loss. So then bankability, equity caution, protect the debts, and debts service reserve account is 1.2 and 1.3 is a required. So let's move on the next slide, guys, where we are going to discuss on the cash flow waterfall, the rule book. So it is also one of the important thing, guys. You need to understand the order of payments from the project revenue, how the project will happen, what are the stage, what get the highest priority while the revenue is generated from the that project. So firstly, get the taxation of operation and maintenance cost, keep assets running. So first, if the revenue is generated, so firstly get the taxation and asset maintenance cost, then senior debt services, you know, the interest and principal will pay to the senior debt services, then that amount will pay to the debt service reserve account, so DSCR. So where the debt service reserve account is a account in which the contain the funds of the 12 months debt and principal. So it's a buffer, so where we contain, and the basis of the all the matrix we take, we created the debt service reserve account, and we keep the amount of debt and principal and the interest rate for the 6 to 12 months if there will happen. Then paid to the major and maintenance reserve, so life cycle complex, the major and maintenance reserve that need to be done. So what are the things? And then the major and debt services, so if applicable, then we pay for the major and debt services, and then distributed service only if covenant meets. So then the distribution then the distribution debt services will happen, and then finally go to the equity holders account. So let's move on the next slide, guys, where we are going to discuss on the how the work together bankability will happen, and how they will work in the bankability. So let's discuss on the special purpose vehicle plus capital stacks plus waterfall, how they will involve to each other. So SPV isolation, where the lender control clean asset, no sponsor contamination. So there is, when lender will contain on the clean asset, no sponsor contamination, there is no required for the sponsor contamination. The capital stack align, equity take first loss more and motivate the performance. So first the loss will happen, so the first loss will take by the equity holders because they are the owners, and then the what, and they need to give unlimited of profit if the profit is done by that organization. And the waterfall protects, no cash leads to equity until the reserve is funded. So no cash leads equity until the reserve is funded. So the reserve means the debt service reserve account, or the major maintenance reserve account. So that will first funded, and then the equity will get the profit. And the bankable deal is, if things goes wrong, do lenders still control the asset and get paid first and have the reserve in their bucket. So let's discuss on the example, guys, where we are going to discuss two example. I already said you in the start. So first one is a 100 MW solar plant, and second one is a 4-lane road construction project. So let's discuss on the project assumptions, that once the bid will give the borrower or the sponsor, then this assumption will happen. So the total project cost is a 10,000 crore. It is a huge in amount. The capital stack is a for 70% senior debt, and 6 to 30% the equity, 12% is internal rate of return. And the revenue for that project, the is a 20-year power purchase agreement with 6 crore megawatt, and the 50% chance of generation of 250,000 megawatt energy per year. So this is the huge in the amount, guys, and that will generate from that the solar plant. And then discuss on the operation and maintenance, where RS 1.5 CR crore kilowatt per year, and it is the cost of 15 lakhs per month for the 15 lakhs month per crore, and every year. So tenure is 18-year door to door and 2 years construction that will conducted. So let's discuss on from that assumptions what are the annual cash flow and why it is a bankable and why that will be the bank will accept this project. So revenue is a 15 crore. Or the 250 megawatt the that generated, and the operation and maintenance cost is a 1.8 cr, and the cash flow available for the debt service is a 13.2 cr. So they have the 13.2 cr the cash flow for the debt service, and senior debt is a 9.1. So debt service coverage ratio, which is nothing but the cash flow available for debt service divided by the debt service, so which is the 1.45x, and it is a target for the 1.3x. So it is a good and it is an acceptable project. We can move to the next stage. So the DSR and the MMRA funding. So where is the minus 1.5 cr, so 50 lakhs to top reserve, and the cash flow equity is a 3.6, so paid as dividend if no default. So that will be paid to the dividend if no default will happen. Why the bankable is important? So special purpose vehicle holds the PPA, power purchase agreement in that case. Okay, and the land lease, the EPC or the warranty lender have the security overall, and the 70% leverage work because the power purchase agreement gives the 20-year contracted revenue, and waterfall reserve the debt paid before the equity, and debt service reserve account is the 6 months and RS for the 4.55 crore over the debt if cloudly season. So these are the first example, guys. Let's move on and discuss the second example, guys, which is and the one of the most important example for the four-lane road projects. So the total cost of that project is 500 million in the US dollar, and this capital stack is a 75% from the senior debt, which is at the 7% rate of interest, and the match is the 5% at 10% in 20%, and equity is a 15% internal rate of return. So concession is a 25 years for that project, and traffic is the 40,000 vehicles per day. So you can understand the 40,000 vehicles are reaching that the per day, and the average two average and the 2% growth in the every year, and the construction is 3 year, and the 22 years is for the operation that project. So let's discuss on the cash flow for 3 years, so we can understand it is acceptable or not acceptable for the projects. So the item and the millions in the notes we discussed, the total revenue generated from that project is a 29.8 million. So it is the 48 1800 VPD 36 day, and two, the operation and maintenance plus major maintenance reserve is a 4 million. Cash flow available for the debt service is a 25.8 million, so it's the using amount, and the senior debt is 18.5. So where in the senior debt we will do the principal plus interest on the 175 million debt, and the debt service is the 1.35x. So to 25 and coordinate is 1.25, which is a good and which is acceptable, and the measurement depth is a minus 3.8. So principal and interest is a 25 measurement depth, and the debt service is 1 point debt service coverage ratio is 1.16, which is the 25.8 divided by 222, and the distribution of equity is a 3.5 after the reserve the funded, after 3.5 CR millions after the reserve is funded. So why the bankable? Why the bank would give this the special purpose vehicle the funds? So the SPV has a concession agreement plus step in rights. So SPV has a concession agreement, and the NHI, National Highway Authority of India, will give the funds on the time, and the step in right governments grant traffic risk sharing, and the above the 20% drops, and the capital stack major takes the traffic risks before the senior debt first loss. Major will take the traffic risks, and the lender will get the less things, and waterfall the lender get paid before the sponsor debt service reserve account, MMDR seats for the downside traffic case. So that's the important, and that in that case we will take these the case. So let's discuss on the key takeaway from this video, guys, and it is and a very interesting video. So the no contract, no financing. Bankability start with the power purchase agreement and the concessions and offtake. So debt service coverage ratio is a king in that case, and debt size. So it is equal to cash flow available for the debt service divided by the debt service is greater than equal to in the probability of 90% cases. So reserve by the time where the debt service reserve account let the project miss by the for the 6 to 12 months without a default if the project is get delay, so marginal effect or the other factors, so we need to do that thing also. And the equity is the buffer if the project underperformance and equity return drop first. So these are the key things which we are going to learn in the infrastructure project finance structure and the bankability, guys. And this is the end of slides. I would like to request you guys, if you are interested in the project finance, quant analyst, business analyst, or the market risk analyst, or the credit analyst, or the different kinds of role in the banks or the IT industry, so please do like and subscribe my channel. So I am continuously creating videos on this topic and help you guys to get a better opportunity in the markets. Once again, thank you so much, guys.